as we look at what's going on in China, it's clear that the economy began to slow there for the second half. And what I believe to be the case is the trade tensions between the United States and China put additional pressure on their economy. And so we saw, as the quarter went on, things like traffic in our retail stores, traffic in our channel partner stores, the reports of the smartphone industry contracting, particularly bad in November. I haven't seen the December number yet, but I would guess that would not be good either. And so that's what we've seen.
That, of course, Apple CEO Tim Cook sitting down with CNBC's Josh Lipton for an exclusive interview moments after the company warned about its first quarter. Mr. Cook citing weakness in China in particular, as you heard there, for the slowdown. Shares are down more than 7% in the after-hours session, taking the NASDAQ, a number of other stocks, down along with it. If you think it's just a tech story, it is far more broad than that. Take a look at some of the industrial names. Very key in the U.S.-China trade talk story. That's Caterpillar, Boeing, among the industrial stocks that have been so sensitive to any development coming out of China. And these are the stocks also that we need to keep an eye on. This is a bigger deal than just Apple and Tesla.
Right. This is the case that it broadens out. You look at 3M as well. They get a lot of revenue, not only from Asia Pacific, but then again, Europe. So these multinationals. If I had to look at a silver lining with the industrials, if for some reason we get a weaker dollar, which it looks like we are against some things, against the yen right now, that might help these guys out. But in general, you're talking about economic slowdown in China that's going to hurt Boeing, Caterpillar, 3M, you name it, pick it, it's going to be a problem.
I wonder as well, sorry, Tim.
Yeah.
You know, the administration, I'm reminded of the interview that Larry Kudlow did on the halftime report where he said there was no end in sight. Those were his words on October the 12th. Talking about this economic boom that we've been in. Did they not think that their trade war with China was going to have this sort of impact on the global economy and some of these companies like Apple this quickly?
I tell you what, it's clear that there was a sense that either it wasn't going to have that impact, Scott, or it was something that actually was going to be very transient.
Or that China was going to capitulate right off the bat?
Well, I think, and I think we've heard a lot of analysis on just, who sized up who better in terms of Trump versus Xi. The bottom line is, if you listen to a Caterpillar, and this is maybe what's concerning, if you listen to Caterpillar management, and recently management was out there with some guidance, they believe that their end markets are either in early or mid-cycle outside of a Turkey or an Argentina, which we know are going through bad times. Look, you saw PMIs around the world this morning. Again, China 49.7 contracting for the first time in 17 months. Europe was in line, but it was at 51.5 on PMIs. The bottom line here is that as asset prices fall and as CEOs begin to cut back on spending and capex, that feeds through to markets. And in fact, it's somewhat circular in the other way as well. And that's what we're seeing.
Tim, don't you think it's interesting with Caterpillar in particular? So consensus for 2019 is for 10% EPS growth on 7% sales growth. The stock trades at the lowest PE that has traded in almost 7 or 8 years. It's telling you that investors don't believe that guidance. So we've gotten to a point. It goes back to your question, Scott, about Apple. Was anyone surprised by the miss? No one was surprised by the miss. They were surprised by the magnitude of the miss and the timing of the miss and the lack of visibility. And so when you think about a Caterpillar, it's really hard to think with like 2/3 of their sales, let's say outside the U.S., how they are not going to have a guide down and how this stock is not going to be trading at single-digit PEs at some point in this cycle.
If you were trying to convince yourself that we were simply in the midst of, Guy, a correction that we just haven't felt in a long time, trying to make the case that this wasn't a full-fledged and longer-lasting bear market, that case harder to make tonight?
Well, it's significantly harder. My case has been this. I think the last 7 or 8 years, the flood of money from central banks has absolutely accounted for more than half of the rise in the stock market. And when global central banks are now taking money away, they're reducing their balance sheets almost across the board, there are ramifications for that. By the way, I happen to think they're doing the right thing. I think this Fed is the first time since Paul Volcker is actually doing what we should be doing, a much different conversation. But I think to the guy's points, there is a chance now, given this news, you're going to have to see companies like Caterpillar guide down. And at 9.5 times forward PE is actually telling you that they're going to have to guide down.
The question is, are we talking tonight, and I realize Apple's the catalyst for this conversation, and we're having this kind of existential conversation. Are we talking about sharply slower growth, or are we talking about recessionary signals? And that to me is what this comes down to.
I think the jury is out, and maybe the jury's going to come back quicker than we thought with the answer or the verdict on that.
I think what you said, quicker than everybody expected, is the key here, right? We all thought that, okay, we know there's going to be some weakness from a trade war, but we thought, hey, if we can get through it and it's better on the other side, let's put up a little bit of that economic weakness. But this happened a lot faster than I think the market expected, and that's the difference here.
I think Jeffrey Gundlach's comment to you is really interesting. I go back and think of the last top in 2007. Cisco had a broad warning in November of 2007, and it predated all of this stuff that we were starting to see. If you go back and you look at that, go back to summer of 2000. LSI Logic had a big pre-announcement. Okay, so when you think about this, and you think about where the supply chains are, and you think about their kind of exposure to this global tech thing, this is kind of right in those sort of things. So when you hear a Gundlach make a comment like that, I think it's pretty interesting.
And we've talked about this on the show. I mean, we talked about it the day J&J came out. We've talked about it when UNA. I mean, leadership in the market in seemingly not technology, not crosshair trade war companies is been the disappointing part about the last, call it 2 months. It's not just FedEx anymore, and certainly not the semis, which we lost in July. It's falling off the leaderboard. And J&J, the headline was asbestos in talcum powder that arguably was already out there. And yet, look at happening. UNH, we will all argue, I think, that healthcare EPS is probably as bulletproof as any sector out there in this environment, yet UNH has gone from basically 285 down to 235, rallied a bit, but again, this is a leadership stock.
We're 48 minutes into the show now, and we haven't talked about bond yields and yield curves that are flattening.
The 10-year is at 264.
An alarming rate.
Earlier.
And so, if we, well, I mean, the point is.
I didn't make my point emphatically enough.
You weren't emphatic in the yield rate.
I don't know.
The point is, I mean, that's been trying to tell a story now for quite some time that maybe the market's listening.
Look, does this put a nail in the tech trade? I don't know how do you make a positive case for tech when you're getting such a large percentage of your revenues from overseas?
The positive case is that everything they talked about, the dollar's going to get weaker because the Fed is unlikely to raise rates, and potentially you get your tariffs.
Yeah.
Now, listen, it's a weak case. I see you shaking your head. I'm not saying it's a very strong case. It is weaker than it was yesterday. If I had made this argument before this Apple earnings, I would have been a lot more bullish than I am today. But the question is now is it too late now?
Yeah, but you're going to hear a lot of people say that, well, what about all these companies that actually don't, Google are not in China, Amazon is not in China.
Hey, all these small cap stocks, which, by the way, have been in their own bear market.
2000. I mean, but I think you have to think
They're
about
the biggest glitch of anything.
But the QQQ, when you think about it, the Nasdaq 100, you guys were just talking about, is so much further to it, closer to its highs than, let's say, some of the components. If you lose Amazon and Google and we already lost Facebook, I think it's important to remember that advertising is one of the most cyclical things that you can have in any economy, and we have not seen a year-over-year drop in that. We may see it in Facebook, but if you see it in Google, that's what's the next leg in the Nasdaq 100.
Key level right there. Watching Amazon as well. I've seen some notes in the past, couple of days saying that anything around $1,500 a share for Amazon's a gift. I wonder if you have to start to rethink these levels now for big technology stocks like the FANGs, which are all going to get brought down. Even further to earth by this Apple announcer.
And if you're looking within FANG, as you point out, Apple and Netflix are pretty glaring in how high they went up, but how they are holding on to more gains because they had more of them. But you can make an argument that those two components of FANG still have a lot of room to.
Yeah, but it really is about MAGA. It's Microsoft, it's Apple, it's Google, and it's Amazon.
We know the acronym.
It really is. It's not the political virus. I'm talking about those four stocks. Okay. What's really important here when you think about it is they all have issues. Ironically, Apple was the single largest beneficiary of that tax cut from a year ago. The single largest beneficiary. And look where we are when you bookend year over year, where Apple is right now. Wouldn't you have thought that this was going to be an amazing thing?
Why were they the single largest beneficiary?
Well, because all the cash that they had overseas and the amnesty that they had on that, and then as far as their profits, their corporate tax rate going down. You don't think they were the single largest?
I'm just curious.
$230 billion in sales.
I don't think that Apple was an outsized winner, and that was the reason for maybe the pulling
How
forward
could
some
you
of that
not, Tim?
outperformance?
They were able, hold on, over the last 5 years, they bought $300 or $200 billion worth of stock back. They've been borrowing it. Hold on, they've been borrowing at zero. They raised $140 billion in stock. They've retired $200 billion worth of shares because they were able to borrow at nothing. Then they get this gift of a 21% tax rate and a repatriation rate of 10%. They were the single largest beneficiary of the tax cut.
In absolute terms, but not in relative terms. And I would just argue that Apple, well before we got the tax cut, was doing what you said. They were doing capital markets engineering, as they were essentially doing bond swaps where they were raising money and bringing, effectively money here back to investors. My simple point was, I wanted to make sure you weren't saying that actually they're even more prone to a fall here based upon how much they gained in an outsized way.
If anything, Apple is closer to the end of this sell-off than any of the others. I mean, Microsoft hasn't had the hit. They're right in the middle. They actually have the most exposure when you think about IP theft and that sort of thing in China. So if this thing gets pushed out, it could be a bigger issue for Microsoft.